Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, and Ben Kingsley, chair of Property Investors Council of Australia and the 2014 and 2015 Property Investment Advisors of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property, finance and money management. Welcome back to the couch, Ben.
G'day, mate. How are you?
Very good.
Pies had a good win.
That was predictable. I knew that was coming.
Yeah. How did Freo go?
Because I knew that was coming. Yeah, we're back.
It's tough, mate, up in Sydney. I think, we beat them up there last year, but that's not easy to do.
I don't need your charity. I don't need your charity. We are going back to scoring under 50 points again, which annoys me.
Yeah.
So,
it's all right.
Hey, a couple of things, Ben. Pick a survey.
Pick a survey, yes.
Getting a bit of momentum, which is good.
Well, so it's the petition.
Petition.
that helps.
The petition.
So the petition, and also obviously memberships would be good too. So if you're interested in becoming a member, but the petition is moving along. We're sort of trying to get over that first milestone, which is 1,000. We've got an audacious goal, but it's about once you sign, share, sign, share, sign, share, sign, share. That'll get that motivation moving.
And as you said, it's about the policy, not about the party. So
not about the party, just about the policy.
We've had some great guests over the last week, Ben.
We've
had Stuart, we've had John, we've had Jeremy. There's a fair bit going on.
There is a heap going on.
But today's our favourite day. We got Q&A day. But I just wanted to let people know, a little bit of anticipation for next week. We got a very high-end heavy hitter. Absolute heavy hitter. His name's
Legal Eagle.
Legal Eagle. And it's to talk about what our community be really interested in. It's about strata, body corporate, owners, corporations, through a heap of FAQs. So we did pre-record that one, Ben. But it's a ripper.
Tim is a ripper.
And he's got a voice for podcasts, hasn't he?
Oh, he has. He's got that voice. He's got that radio voice.
I should borrow him for my voiceovers. So tune in for that next week, folks. Just a reminder, we are getting to the pointy end of our book, and we are getting some great feedback from people, like money hacks, offset hacks, all those sorts of things.
Beautiful.
If you've had an experience with the money smarts, let us know. We'll include in the book. But what we also want to know, Ben, is where are the temptations? If you've set up the money smart system, where are you most tempted to deviate from the script? Because that's what we are particularly interested in knowing as we get through the copy in this book. Where do your temptations live? Because we would love to know where they are to make sure we've covered absolutely everything in this book, Ben.
Correct.
And Ben, just a little sneaky, I saw the first episode that I did of Escape from the City on the weekend. Oh, thanks for that warm enthusiasm, Iris.
Oh, great.
It's coming up nice, which is good.
Excellent, congratulations.
Look
forward to seeing it.
Booked me in for 3 hours of VO on Tuesday, and we got it done in an hour, which was nice.
Perfect.
So
that's voiceover for those of you who are in the industry. His shop talk. We've got to get him out of his shop talk.
So the point in saying that was to two reasons. One, a little bit of pride that it's going well, and two, just to remind people that it's coming up, Ben.
We're excited to see it. We're excited to see it. We might have to do a world premiere. Who knows?
And just one last thing, Ben. A little special request to our listeners, Ben. It's getting increasingly crowded to get the attention of our listeners' ears, Ben, because there's lots and lots of options for them.
More podcasts coming out
to listen to. So if they've enjoyed ours, Ben, if they've got an opportunity to give us a rating, we'd love it to be on the higher end than the lower end, but whatever you choose, because the algorithm helps us rank in iTunes so that more people can listen to our stuff. So if there's an opportunity.
And we're coming to Spotify real soon. That's just real soon. So watch this space.
Watch this space. All right, bring it on. Hey, my mindset minute theme. My eldest Jack has started basketball. Yours?
My boys have started basketball.
And I don't know how it is for you, Ben, but we get there on the weekend, and Jack just loves to be around his mates, right? So he just runs up, and I think he's oblivious to the fact that there's a basketball on the court. As long as he's hanging out, runs up and down. And it's interesting for me, as you know, we're both highly competitive, and it's interesting as you watch your children do a competitive sport, how you've got to make sure that you don't project onto them, right? And he comes off the court, and he's just got the biggest smile on his face. He's hardly touched the ball. But as long as he's with his mates, he's happy. And so he says to me, Dad, our results have been like a seesaw. So the first week we won, the second week we drew, And then the third week we lost. So he's got this clear linear line. So it's like, see, so I go, what? I said, are you having fun? And he goes, yeah, absolutely, I'm having fun. So my mindset minute today, and it's a Nelson Mandela quote, Ben, is you either win or you learn. Because, and Jack's the epitome of that for me, because he's either winning and he's stoked, or he gets off the court and he goes, I think this is what we can do better, maybe this is how we can win next week. So he is, in that childhood innocence, the epitome of you don't win or lose, you either win or you learn. So there you go, Ivis. A little message for those folks who are out there.
Well, we haven't even come close. We've scored in 2 games, and the rest of them have been like 32-0 or
really?
28-0. So we've been shellacked.
But is it grading games?
Right. Grading games to start with, but now we're in the regular season.
Yeah.
But we've got a lot to do. But that's good because you can see progress. Like if you think about the first game I watched them play, they didn't even get to shoot. Like they didn't even get the ball past halfway. Right? They couldn't even dribble. So you're now seeing them dribbling up the court, and now they're probably averaging 6 shots a game. That's progress. So yeah, it's all good.
I agree. There's a real disparity in our team. We've got Jack, who's loving being involved, and then we've got Jude, he's just like, what's he like? It's like Tony Lockett. It's just everyone passes in the ball, he bullets it in, he gets it in, so he loves it. So there you go,
You've
mindset.
got that 1-star player.
Hey, Q&A day today, and Ben, we've got a bit of a treat. We have got some people, we've got some guest questions.
We do.
So let's
rip into them.
Rip into them.
Hi guys, Mel here from Melbourne. Love the podcast. My question to you is about growth. Buying a growth property in either the Melbourne or the Brisbane markets, given their different positions at the moment. If you had $650 to spend, would you be better in terms of growth to buy a smaller property further out, a house I'm talking about, further out of Melbourne, or a larger property closer in Brisbane with a buy and hold strategy of 15 to 20 years? Thanks. Looking forward to hearing your thoughts.
Well, there you go, Ben.
Mel.
Good question from Mel. Thank you for that.
Great starting question, Mel. So interesting that he wanted to have the house as opposed to wanting to potentially move a little bit closer in and have the townhouse, which might have a similar configuration, which it might be a 3-bedroom, 2-bathroom, as opposed to maybe a 4-bedroom, 2-bathroom, double living zone. So one of the things you've got to focus in on is what do people want, okay? In terms of, do they want convenience? Do they want proximity? Do they want all of the bells and whistles? Are they happy to go into a more consolidated home or dwelling as opposed to having that big, large space? Now, if all things were equal, we'd all want to have big open space, outdoor alfresco area, 2 different living zones, and be in Middle Park, right? But for that sort of price point, you're talking maybe 4 to 5 million, right? That's Melbourne, and obviously there's examples everywhere around Australia. So that's when we start to compromise on that. So Mel, when we're doing this, professionally, the first thing we say to ourselves is, well, what type of return we want to get over a period of time? Because ultimately that's how we're accountable. Okay, so we sort of set a goal, because the reality is we all want the very best return that we can possibly get. Now, looking 10, 20 years into the future, the only reliable thing that we've got to look at is historical performance. Now, that's still no guarantee of future performance, because there will be areas that will gentrify over time, and that's that ripple effect that we talk about and Jeremy talks about as well. So for me, when I'm focusing in on this type of story of that 10 to 20 years, I'm more prone to focus on what type of asset in the location. Remember, location does most of the lifting. So I don't really want to have to go out wide thinking that I'm getting a better asset that people are appealing, because if they're not appealed to the area, if it doesn't drive them to the area, they may not, they might have the best home, but in the wrong location. So I take a holistic approach to this in the sense that I can't guarantee whether Brisbane or Melbourne over that longer term, generally speaking, is going to be a better return. So that's when I've got to start doing my, basically get the engine, which is the DSR, so demand supply ratio, and start to look at that story, okay? And that's going to help me out in terms of the short term, because what basically demand and supply shows us in terms of capital growth is usually 1 to 3 years, and at a stretch 5 years. So what I'm doing is I'm looking at the short-term growth story and marrying that up with the long-term growth story. So the short-term growth story could show me some areas that are quite interesting for me that are out wide, because that's a population growth story or whatever, and that might give me a short-term spike. But Mel's looking for consistent long-term returns. So if I'm looking at consistent long-term returns, I'm going to do a marriage of the two. So I'm going to see where I can find a good score in the demand and supply closer in, and then I'm going to start having a look at the type of asset that I want to buy. So in Sydney, I'm accepting of units and I'm accepting of townhouses, very much so. In Melbourne, I'm now starting to get accepting of townhouses. In fact, there were some articles in the paper recently around how some townhouses have been outperforming houses in certain locations. That's that indication of people sort of saying, I'm not going to move wider, I'm going to basically get that asset that's going to appeal to me. Because remember, owner-occupier appeal is what we're looking for.
Land value, not land content.
Yeah. Now, so I then come back to the story. If I'm looking at, and we look at between a 10 to an 11% overall return. So if I'm trying to get, say, 6.5% growth, then technically I'm looking at sort of 5% yield to be able to get that to me. Sorry, 4.5% yield. My bad, that's 11.5. So that's what I'm trying to get, that marriage in terms of what I can find for that client. Because you've got to remember, when you're a professional advisor, you're playing with other people's money here, and we're not going to spruik areas and say, right, this area is going to be the best ever area. I've made your money do I've got the perfect science. No one's got the perfect science. No. You're trying to increase the probability of success. So with the DSR ratio, what we're talking about there is increasing the probability of success to the likes of around 80%. So 70, 80% is where that reliability, and in some cases up to 90% based on the variables that we're looking at. So that gives us some confidence to go into those locations. So if I spent $650 in a great property, in a great suburb in Brisbane, tick. But also, if I was taking the long game, I know even though Melbourne's cooling off a little bit, I'm still sitting back going, I want a property in Melbourne inside my portfolio.
Yeah, Ben, I think you've summed it up really well. I think the key point that Mal's given us here is that 15 to 20 year outlook, right? Because ultimately, if you just avoid or anyone's opinion, just go and look at the facts. Those two cities are going to go through an enormous population growth, right? Yep. So just by sheer numbers of demand exceeding supply, if you put your money in either of those two cities, I think that you'll do well, right? If we're going through a comparison debate here, and it's only going to be our opinion, someone else might differ, but what I can buy for a house for $650 in Brisbane, I can come a lot closer in, Ben, than what I can in Melbourne for $650 for a house. So apple for apple. Yep. So given what we're talking about here and where we are in the cycle, and given the length of time, and if Mal lives in Melbourne, so if he was open to being a borderless investor, I would probably lean towards getting a house closer in Brisbane.
In the current environment.
In the current environment. Yep. But the caveat is, if you did it in Melbourne, I don't think it's a booby price.
No, I think a townhouse in Melbourne will be just as good.
Absolutely. So, but the thing that what we are experiencing in our own experience on the ground in Brisbane is we're getting a little bit more yield up there right now. Yeah. So, see, there's a few things that are, which is why we always say generalised commentary helps no one, because I'd like to know a bit more about Mel, what he wants, what he's got, what the circumstances are. But based on what we know, and based as just an addition to what you said, I'd say if I couldn't be a politician and sit on the fence, I'd be leaning towards getting a house closer in Brissy than I would in Melbourne. But I would, people think, oh, Melbourne's coming off the ball. Well, I can tell you, the properties that we're looking at, and we're buying investment grade properties, Ben, not investment stocks. They are still under competition, even though the clearance rate's dropping. The clearance rate on the stuff we're buying isn't dropping.
Well, it's the same argument we were saying before. Big population predictions for both centres doesn't guarantee that the rising tide's going to lift all ships.
No.
When interest rates go up, we're going to see who's been swimming naked. And that's why I always like to go into those areas where the education of the people and the income of the people are more reliable, especially in a world of rapid innovation change. The people who are going to thrive, and not just survive but thrive, are going to be educated people. Uneducated people, their jobs are at risk.
Yeah,
so if you're in work that is that could be challenged by technology and robots, then that's the reality. Now, some could argue that some white collar clerical work and administrative work is going to go. Don't disagree with that. So making sure that you're in an area where the vast majority of the people are tertiary educated, have reasonable intelligence and good income, they're the areas that I think will do better in the next decade than areas that might have done well with historical low interest rates.
And Ben, that's just a byproduct, isn't it, of the increasing standard of living that we enjoy ongoing. So,
correct.
And there are minorities of people who will be negatively affected by what you said, and certainly no discrimination. But ultimately, we enjoy a better lifestyle than some of our Southeast Asian neighbours.
Yep.
And so for them to replace some of those jobs, that's increasing their standard of living, even though that reference to us is potentially lower. So, yeah, I agree. But I think it's a good question, Mel. I think it's a question that a lot of listeners will have. But I would encourage you. Yeah, absolutely. Yep. And to be honest, we have to deal with that question daily in the BA team, because the client will say that variation of that question. And so it's a judgment call. But ultimately, I think we're blessed in this country, particularly on the East Coast, Ben, that the population projections for this empty island syndrome that we have, where we're highly urbanised in coastal locations. We're not like America where there's populations all across the country. Here we are highly urbanised in these little pockets. So on the East Coast, which is the highest demand centre, and even as you go to Brisbane, as that lifestyle is going to increase, and even through the cycle that we've just experienced, with Sydney folks having a boatload of cash where they could sell their house, move up to Queensland, have plenty of change, have a lifestyle, so that'll place increasing demand in that market as well.
Because how do we do it? We do it simply through fundamental research and technical research. So the fundamental research that we're doing is where's the demand and supply the tightest? Where's demand high and supply tight? That'll take us in to further inquiry, and then we do our field research, which is, okay, what's on the ground, what's happening in regards to the sentiment of the area, the confidence of the area, the gentrification of the area, who's coming in, what are they like. That's going to give us confidence for the long term, not just the short term. Because if it is just about buying an asset because basically it's showing a really high yield, but it's in a really low socio-demographic area, well, if we've got high yielding people, we might go there. But if this is a growth story, our question is, might have some growth, some short-term growth. And if you want to be an active investor and then release the equity out of that, but our clients are like, no, I just basically 10, 20 years, passive investment, just let it do its thing.
See you in 20 years.
See you in 20 years. We'll check in every couple of years. Ultimately, that's what we're looking for in terms of sustainable long-term return.
Can I just put a footnote on that, Ben? Again, highlighting the generalised commentary. Just be aware that Melbourne, it's still a good time to be buying, notwithstanding what we just said, it's still a good time to be buying in Melbourne, because if people are getting seduced by headlines, seeing clearance rates come off, make no mistake that the investment grade properties that we're targeting are cheaper today than they are tomorrow and the day after, and that will continue to be the same. Will the market enjoy the same spoils of the last 5 years? I don't think so.
Yeah.
Will properties go down in value in the areas that we're targeting? I don't think so,
Ben. It's unlikely unless there's a
major external shock event.
Yep, exactly.
So my message to our listeners, and give you an edge over everyone else, is don't be seduced by the headline right now, because even Sydney, who's getting copped with negative headlines right now, the best areas in Sydney, if someone's looking for scarce assets that are investment grade, that are in that affordability belt, not in the top 25% quartile, like in other words, the $8 million, the $10 million properties, the $5 million properties, don't touch them, unless you're on $2 million a year. But if you're like the rest of us, then ultimately you still want to be going into that bandwidth, that median price point, and try and get around 10% of that median price point in these types of times, because the compression risk, which is the risk of it going down, is low. Then ultimately, the uplift is high once that next cycle comes through. And look, little blatant plug, try out Location Score. That's going to tell you where to start looking. That's going to, it's a safety net.
It's a safety net, and it's a time saver.
Very good. Thanks, Mel. Great question. I think we had some really good sort of tangent points on that, hopefully for the benefit of the listeners. All right, I got one from Dennis.
Hi, Bryce and Ben. My name is Dennis, living in Melbourne with my fiancée in our early 30s. We are fans of your podcast, very informative. I have some equity from my family home I co-paid with my parents, and after borrowing, our budget is about $500K. We're looking to invest in our first property. First consideration is a 3 to 4 bedroom house in Ballarat, because Ballarat West Economic Zone is up and coming and is aiming to create 9,000 jobs. Second consideration is 2 bedroom beachfront apartment within 10 minutes of Apollo Bay Lawn Central area. We plan to rent it out as a Airbnb. However, our concern is the long vacancy periods during the colder months. What are your thoughts on both options? Which is the first better investment property? Are we looking to hold long term? Unlikely to sell within 5 years. Thanks. Hopefully we can hear more tips from you. Thank you. Bye.
All right, Ben, there's a bit in that for everyone.
A lot in that. Yeah,
let's unpack it.
Well, firstly, there's a word we haven't used for a while. So, Dennis, good on you to thinking about how you're going to take you and your fiancée forward in terms of your wealth creation story. So, a couple of ideas there. One is to look at, obviously, a regional town, but technically, almost being swallowed up by Melbourne and probably will be over the next 20 odd years. Okay, so an hour's drive from a major metropolitan centre and still technically reasonably affordable. So you could still work on the fringes of Melbourne or get the train right into the heart of Melbourne and basically draw a higher income and go and live out there. Now, you're not living out there, but that's the type of story we need to have confidence in price growth in a particular market like Ballarat. And we bought a lot of properties in Ballarat between 2010 and around 2013. I think it was about 55 odd properties that we bought up there. And our price point when we were buying up there, Bryce, was between 170 and up to about 250. Okay, now those properties are in that sort of 300 plus range now. So those clients have done very, very well in that particular timing of the cycle. We are now seeing Geelong doing very, very well, and people looking at Geelong as a lifestyle core. And I think Ballarat's also getting that. Now Geelong gets a little bit more because it's got the surf coast, so it's got that that water appeal that all of us Australians love. So we're seeing
it's got the factor that every other AFL team in the country hates, is they keep on scooping up amazing footballers who want to enjoy that lifestyle.
Yeah, well, some of them were from there to their credit.
Don't let that get in the way, Ben. That doesn't suit my story.
So Ballarat's an interesting story. I mean, at that price point, you're going to get
a monster.
I was going to say you're going to get a period style property, which in the right suburbs of Ballarat is going to also potentially attract even a transient doctor.
Yep.
So a doctor on rotation out to the Ballarat Hospital. You're going to also potentially attract those people who are transient but getting good incomes up there. So the challenge then is that property going to do the best return? My view on that is I absolutely want to be, if I'm paying that sort of money, I want to be in the elite areas of Ballarat, okay? I want to be in the best areas of Ballarat, the best streets of Ballarat to try and get that type of property, and I want it to be pretty much well finished. So I want to have that owner-occupier appeal straight away, so it's really nice and rentable. You might say, if you're prepared to do some work, Dennis, and go in there and tidy it up, pay $400, put a reno onto it, and you'll get an equity harvest on that. But if we're just sort of thinking about pure investing, passive investing, where do I sign, get the tenant in there, I'm back to my life, then the reality is Ballarat's that story. Now, the beachside story down towards Apollo Bay. So a couple of things you need to understand with Apollo Bay. There's two ways to get down to Apollo Bay.
Summer.
You basically go the back way, up through the Otways, or you come along the Great Ocean Road. Now the Great Ocean Road is a tourism mecca and does not function for about 3 months of the year, where you can get caught behind tourist buses. It's just a nightmare, right? So a lot of people who are going to go down there are going to go through the Otways and cut down into Apollo Bay. Now, my view on Apollo Bay and anywhere along those areas, yes, it will be attractive for Airbnb, probably not for our winter months, so those periods, but in the summer months you can obviously yield pretty well because everyone wants to head to the coast during that time. I don't believe the capital growth story is going to be there, and I think it's, so between the Ballarat story and the beachside story of an apartment, I would be challenging the growth story on that apartment compared to what I could buy for $500,000 in Ballarat. So I'm all about growth, so I would probably be leaning into Ballarat.
Yeah, here, Ben. I think that was my suggestion to Dennis, is that are you after growth or yield? Because the yield could be very nice in that period of time over summer, which may give you a really good cash flow over the year. But if you're after growth, I think if the listeners because we're wanting to try and teach people how to fish rather than give them a fish here, right? If you think about the podcast that we went to where we said, what's the most important infrastructure for property growth? We talked about it being jobs infrastructure. So overlay that as a framework. Where are the people getting the jobs in Lawrence/Apollo Bay, which is an amazing spot.
Great
it's
spot
just
for
beautiful. Versus Ballarat. Because we got Brad in the office here, Ben. He travels longer to work from Box Hill, which is a suburban Melbourne suburb, than it takes for someone in Ballarat to get into the office. But Ballarat's considered, a regional town further out. So the people in Ballarat have access to capital city job market and good incomes. Plus, within that town, there's wonderful opportunities for six-figure incomes for medical professionals. Universities.
IBM's up there.
So that would be the framework that you would need to overlay as a listener, because the next question becomes, what about, Margaret River versus, City Beach, or, I'm just picking something at random here, but you'll need to overlay this anywhere in Australia, and the same principles apply. How do you get, because the Gold Coast is another one, right? I used to live on the Gold Coast, and I commuted to get a capital city income in Brissy. But if I'm in northern New South Wales, which I'm only a little bit further down the road, that's a significant difference, because to get access to the Brisbane marketplace means I have to get up significantly earlier. I'm going to have to drive up to Varsity Lakes, and then I'm going to have to park my car, and then I'm going to have to get on the training into Brisbane. That really eats into lifestyle. So these are the frameworks that I'm suggesting our listeners overlay. Where's the jobs infrastructure, starting point, and then you can build a case for this question being overlaid anywhere in Australia.
Because it's the Pacific Highway, isn't it? It runs down from Goldie to Brissy, right? Now we're talking about widening that. So you saw in the federal budget as part of infrastructure spend, so this is where we connect into what the infrastructure spends are. If we get 2 more lanes each way, all of a sudden that commute time from the Goldie up into a capital city marketplace, jobs marketplace, becomes that little bit more plausible. And that's, I can go down to the Goldie and have my weekend lifestyle, but I can go and get my good incomes, because that's where the Goldie struggles in terms of having corporate opportunity there. So that's the challenge. So we've been buying in the Goldie. We know that we've been that's been a yield and a balance play.
We've been buying in the southern and the Sunshine Coast bend. So Noosa, for example, is just that little bit further north, which means getting access to. So if I'm living in Noosa, what am I going to work as a job? And I'm thinking the general population, not someone who's a specialist IT person working from home on squillions.
Correct.
What does the general population within the Noosa marketplace do for a living? Well, it's probably hospitality, it's probably services, it's probably, cafes and restaurants. And
correct. It's tourism based, it's low, it's normally, sort of minimum wage or sort of weekend overtime.
They're not shooting the lights out. So, and those people are the people who have to buy the real estate in the market. And so it's not us coming in,
because the value of our property is based on the value of everyone else's property. Ultimately our property is comparable to the other properties in the market. So if you've got literally hundreds and hundreds of workers earning good income,
it's like Canberra. Canberra doesn't necessarily, and I'll potentially offend the Canberrans here, but it's not blessed with geographical wonders. I mean, you can't go for a surf.
I'd argue it's pretty close to the ski fields, and
Well, that's true. It's a good point.
But you're right. Big
people are there because collectively they work for the government in a lot of cases, and there's good incomes.
Services, massive consultancy numbers and values. And that's why
so collectively as a group, that population has, and hence that's why that marketplace is more expensive than Brisbane, for example.
And here's an example, right? And I'm going to offend our Canberran friends, so apologies in advance. But gee, some of that property up there is ugly. Like, it's like, do you know what I mean? Like when we were driving around.
You sure?
Yeah. When we were driving around, we weren't inspired by the architecture.
You're not seeing architectural inspiration.
No, there are pockets where it's different.
What about those houses where all the embassies are?
There's something there, but it's eclectic, isn't it? It's not consistent. Whereas you drive through some of the, and again, I'm not trying to be controversial, but the value of those properties is enormous because it's relative to the incomes in the area.
Yeah, I see
so I'm not judging. I'm judging the properties there And so, because people might look and say, oh, I can understand why that Edwardian's worth 2.5 million.
Because it looks great.
It's stunning.
Yeah.
And everyone agrees with that. And then I go to Canberra and I'm like, I flick through my slide list of all of these unattractive properties, Victor. And then I go, right, and I go, but how can they be worth the same sort of price point? Because the income justifies the story. Yeah. And it's still the best of a bad bunch. So that's the message that I'm sort of talking about there.
All opinions voiced here are our own. They doesn't represent any voice of the party.
Well, I'm not trying to
I know you're not. I know what you're trying to build a very good case there. And I think if people hear the message of what you were just saying, it's powerful. And another example of overlaying the message you just said was in the first season of the show, I had to do a story in Mount Newman, up in the Pilbara region of Western Australia. Now, mate, same thing. I don't know if you've ever been to Mount Newman, mate. But again, I'm potentially going to offend some people, but you're not going there for the architecture. Yeah. You are going up there to drive a big truck and earn a big income, or you're part some way of crushing that rock and getting it to the coast. You're in some part of that, and that's why you're there, right? But you would go there and you get a 3-bedroom steel constructed house in red dust, over $1 million. Back in 2000 and help me out of here, it was 2008 or 9 or 10, something like that, right? So, but I would look out the front and go, $1 million? That was back when you could buy a single fronter with the works in Yarraville back then for 600,000. $1 million, and it's the same story. The jobs infrastructure is there. The mines are paying big cash. Everyone collectively lifted the average, which lifted the average of the prices. So that's the point that you were trying to make.
It is. It's still relative. So out of the best of a bad bunch, and again, apologies to our Canberrians, there are some lovely homes there, but generally speaking, a lot of it is the architecture is pretty bland. The landscape is a la natural. So normally that means plenty of gum trees that are throwing plenty of branches and leaves and gum nuts and everything everywhere. It's not, manicured lawns and beautiful. And that's, people, have a vision of a home being white picket fence and being beautiful. That's the challenge you've got there.
Yep. So hopefully, Dennis, that will help you, but it'll also help the listeners overlay a framework on every single Ballarat versus lawn question anyone has ever got.
Love it.
Just overlay that framework.
Love the way you segued to that, mate. Good job.
So, all right, we've got one here from Jennifer, Ben. Jennifer. Here we go.
Hi, Ben and Bryce. I'm a huge fan of your podcast and book, and I'm very much looking forward to your new book. I recently read another popular finance book, and their recommendation was that investing in property long term is not a great investment because although property prices do almost always increase, the costs associated with property investment like interest and property management fees, repairs and renovations are so high that it makes a poor investment and that you'd therefore likely get a better return with something like a shares portfolio. I'd just like to know your thoughts. Thank you.
Oh, Ben, another good one there.
Jennifer, look, I mean, the reality is that people have biases, right? We talk about, do I need a haircut? And you're asking a barber. Right now, you're about to have a conversation with Jennifer about whether we would invest in bricks and mortar or whether we invest in shares. The reality is, and I've said this before, if you pick the right share, you will outperform property every day of the week. I don't know of any property that could get 1,000% return like a share could, okay? The big challenge is, however...
Which one?
And when you get that 1,000% return, is that going to then, go again? And, is it going to be a 10-bagger, as they call them, which is basically, doubling every year for 10 years, which is an incredible stock. And we'll always say that. I mean, there are some amazing companies, because remember, we don't buy the stock, we buy the company. So CSL, great example, Commonwealth Serum Laboratory, shooting the lights out, basically best subject matter expert. They are the world's best in their domain of blood plasma, vaccinations, those types of things. An incredible company that continues to thrive. So if you got into them, terrific. And I was one of the people who got on the float. I actually did a little bit of a sort of my story on Money Magazine last month. And I said I bought a little bit of, and if I had kept those stocks, I tripled my money and sold out. So that's what happens. So we are not anti-share, and we are not anti anyone putting their best foot forward in terms of the content that they know. So the writer of the book that you may be referring to, there's a bias. That particular writer might have a bias towards share market or investing in businesses as opposed to investing in bricks and mortar.
Because we've got a bias.
Yeah, we do. We have a clear bias, and all of our listeners know where we come from. But I'm not about to get into the argument of shares versus property. There's no real benefit in that. What I would be talking about is volatility, and we heard from Stuart Wemyss last week in terms of what that looks like. Is that you've got a tremendous amount of volatility in the share market, and if you can get your mindset around that, then you are investing it through super, right? For us, we think that there is a way in which you can pick outperforming properties inside the residential property market, and if done well, you will build yourself up a passive income for life by buying, effectively 3 or 4 good properties over the long term, and hopefully it won't ruin your life, because you won't be coming home every night looking in the paper and going, oh God, 8% drop in my share. Oh, you just don't do that. So I think the important message there is you've got to understand that we have biases. We all have them. I have a bias to Collingwood. You have a bias towards Freo. These things are in our life. There's natural conflicts and in everything that we do. You've got to filter through that and be comfortable with your decision making. And this is for all of our listeners. In terms of people see bricks and mortar over the long term being relatively reliable and less volatile. We get volatility in property markets when we get greed and we get excesses, just like in any other market, because it's a supply and demand story. So if you had a bought in Gladstone in the boom, you needed to get out. Mackay, all of the mining towns in the West Coast, all of those things have cycles. In the bigger cities, they still have cycles, but they're not as volatile. So there are markets within markets.
Very good, Ben. Frameworks for the listeners.
Yes.
For me, first one is whenever I get the shares versus property debate, I say exactly what you said. I'm heavily biased towards property and I'm not anti-shares, but I'm not the guy to talk about the shares. So what I say is leverage. So I can get more leverage on residential real estate generally than I can with blue chip shares. And then
without a margin call.
Yep. So then I just say add whatever growth rate you want on either of those and just see what the numbers look like. But notwithstanding what you just said, if someone's good at shares, they can do a beautiful sort of bull run and it's no problem.
I've seen some incredible share investors who have transformed their lives through, but they are guessing. They are fundamental researchers. They spend hours and hours, just like a good property investor should, in picking the right stock or the right business to invest in.
And the point that you made too is that shares are just a derivative of a business.
Correct.
And we believe in business. We're building one ourselves. So it's not as if there's no bias against it. It's just what's our strength. So that's one. So leverage is something to think about. 2, let's assume you bought a $500,000 property, Ben. Cost you $10,000 a year. You held it for 10 years and it doubled. All right, so it's worth $1 million. Less the 500 you originally owe, it's 500. But it's cost you 10,000 a year for 10 years, so it's cost you 100,000 to own. So $500,000 profit less the $100,000 holding cost is 400. Now let's be conservative. Let's say it cost us 20 grand a year. So instead of 100, it cost us 200 over the 10 years. 500 less 200 equals 300. Let's be conservative again. Let's just say the time value of money means 100,000 just got wiped off. So we now go 500,000 less 300. For over 10 years, we're still 200,000 in front on very, very conservative assumptions, including holding costs for property if you buy the right one. Sure, they don't all double in 10 years, I get that. But that's another framework for you to overlay when you're answering these sorts of questions. And the third one, Ben, is our book is going to have, it's a prequel. Our book is deliberately a prequel, not a sequel to our existing book. Because once you've read our current book that we're writing, you then have a choice. We're going to help you better trap the surplus.
Correct.
And then you've got a fork in the road.
Yep.
It's a prequel if you want to continue the story on our path, you go and read our existing book.
Yep.
Or at that point in time, you can suitably pivot to whichever way you want to go. Cryptocurrency, business, shares, whichever way. It's a prequel to every single decision that people like Jennifer are making at this very point now.
Mate, well summarised, and I think it's important to understand that there are biases. So once you determine your comfort zone, or you might want a combination of all things in terms of diversification. So from that point of view, it's going to come down to case by case. My advice is to seek some professional advice to work out where you feel comfortable, to understand the concepts of cash on cash returns, to understand the concept of leverage, because we know leverage can also be dangerous when done to excess. So that's why we're very, very big on our 4 principles of A, B, C, D. So cash flow management first, borrowing next, then basically asset selection, and then defence. You get those principles right, you're going to be well served.
Well said. All right, I got one from Steve.
Hi guys, my question was, how do you know when it's the best time to sell an area? Like they say with the stock market, no one rings a bell at the top. I wouldn't expect to be able to pick the top, but how do you decide when is the best time to sell? Is it data-driven, like where yields are now low and it's had years of growth and now there isn't any affordability as the average mortgage is, say, like 40% of the average income loan? Or is it more of a sentiment-driven thing where the market's now too crazy, people are bidding way over reserve, so you should just sell into that? The reason I ask, I bought a Gold Coast 4x2 house for $350K in 2014. It's worth around $420 now. At some stage, the Goldie's run will end and it will be level out, and this may be one earmarked to sell. So I think it's very easy to look back at a chart of a price growth and point at where you would have, should have sold. It's much more difficult when you're in the middle of it. I kind of thought Hobart and Geelong are good examples now of strong markets now that would be a good test to work out when their optimal time to sell into would have been. I worked in Perth for 10 years. Go the Dockers, made the Pies collect many more wooden spoons. I've only been to one AFL Grand Final in 2011, and it certainly warmed my heart to see so many devastated Collingwood supporters in one place. Unfortunately, I've never actually seen any happy Freo supporters in that ground on that day. Keep up the good work, boys.
Steve.
That would have been the most perfect question if that last little bit wasn't necessary about the happy Freo supporters, but the rest was beautiful, wasn't it?
I don't know what you're talking about. I was there that day. I was there. We were up at half time. We were up, at one point there in the second quarter, we got up by around 24 points. And the chant went out, Collingwood.
Spoon.
Challenging, but thank you.
Ben, I must admit, I listened to these SpeakPipe questions. We've prioritised them. We've said to people that if they do that, we'll take them to the top. I normally only need to listen to them once. But I've got to say, I listened to that ending a few times. I've got to say.
Good for you, Steve, and thank you for returning the serve. Lovely work. Okay, great question, though, in terms of do we sell? So there's a fair bit in here, but I'm going to unpack. We're into the unpack mode of what you need to do to work out whether it is to sell.
Oh,
okay.
Come on.
So, there's a few moving parts here. This is not easy to do.
No.
All right, but this is what you've got to look for, in a relatively top-line point of view. So the first thing you've got to do is work out your selling costs. Okay, so selling costs we would talk about is obviously the capital gains potential, the agents' fees, advertising, any sort of other costs that you've got there, and you work that out. Once you understand your capital acquisition cost originally to adjust for your capital growth and those calculations. So there's a fair bit in that work, right? So we got that, okay? Then we're working out the recycle costs. Okay, so if you've made a profit, then technically you should be able to go back into the market at whatever profit you've made, and you might want to add a little bit more, right? Because if you want to keep leveraging and keep going, then that's recycle cost. If you've lost money, however, your $400,000 property is an example and it's now worth $350 because you bought the wrong asset, then you're going to have less to invest the next time around. So we talk about recycle cost, and then we basically need to make a prediction on where there are better markets to invest your money, where you're going to get a better return. So you can compare it with another property, or you can compare it with a share portfolio that you want to invest in, and what your costs are. So there is the selling costs, the acquisition costs, the recycle cost, okay, and then ultimately, just to throw it all around, there's a thing called this opportunity cost. And the final thing that you need to factor in is when you are looking at comparable markets, you need to make a prediction.
Oh.
This is the challenging bit, right?
Yeah.
This is where you need to predict what that property is going to grow by over the course of the next couple of years. Now, if the prediction is, as Steve rightly pointed out, that it's on a downward part of the cycle and the property prices are now going lower, then you need to know how long that's going to last for, and is there other markets that you can get better returns in. So on the whole, there's a lot of costs getting in and out of property, right? So that's why...
Puts pressure on the next one, Ben.
Correct. That's why transacting properties is expensive. But if you pivoted out of that into a business that you were super confident on was going to make you more money, well, your decision is going to be made for you based on your opportunity cost. If you were pivoting it out of that to get into the share market or whatever, again, it's going to be working out what your confidence are of the performance return on what you're about to get into. Now, if you're pivoting out of one property to get into another property, which is what a lot of property investors may do and may think about, then it's all of those things. It's the exit costs, the recycle costs, and the predictions of what this new property is going to do compared to what the old property is going to do. So it's hard work, and our team do it here in terms of when a client wants a review of their portfolio, we'll assess that for them. It's difficult work. We're going to try and make it easy. We've got something coming up.
Well, I was about to say, Ben, you've been in the Capital Growth Lab with
Jeremy,
with the lads, and you. I was about to say to the listeners, if you're wondering why you're so passionate about this, is because you've been working on something.
Yeah, we have. We're trying to build. We're going to build a model.
Yeah.
That's probably the best way.
That answers this question.
Yep. That's exactly what that product will do. Is answer this question.
So frameworks, Ben. My very first mentor, property mentor, back in 1998.
Yes.
And he said to me, never ever sell. Never ever sell. I've slightly tweaked that to hardly ever sell, because there are some times.
Yep.
But I think his mantra is strong, right? So my response here for Steve is, just bear in mind that he said Gold Coast is going to go for flat. I have property on the Gold Coast, Ben. I have experienced the flat time. But I just think that it's worthy to note that it's in the top 10 population centres. It's in fact number 6 and won't lose its position for the predictions of 2050. So it'll have more population. The only people, Sydney, Melbourne, Perth, Brisbane, Adelaide will be the only cities with a greater population than the Gold Coast, the coast with the most. So that's important to understand, that place is limited. It's limited by the hinterland at the back, the coast at the front, the border on the south, and of course Brisbane and the Gold Coast will eventually meet
it's
up.
all going to merge. That whole south
It'll be one big
super centre. Yep.
So just bear in mind, and we don't know where it is on the Gold Coast, but if you feel like you're in a geographically strong location that's surrounded by canals and beach and infrastructure and
no vacant land,
no vacant
land,
oversupply, and you've bought it for, I can't remember what price he said. Ben, did you write that down?
320, I think he said. And it's now
but it's grown. Yep. So it's grown in value.
Yep.
And if the yield is performing strong, and based on exactly what you said, if you've actually really done the maths on whether you should get in and out, I'd say potentially hold that for the long term. And I guess the other framework, and you hinted on it, passive versus active. Which one are you?
Yep.
If you're active,
maybe you want to keep transacting. Just be mindful that a lot of transacting that goes on, you're giving a lot of money to the government. So those fireworks and New Year's Eve, you probably paid for a lot of them.
Ben just covered some, exactly. Ben just covered some gold. I would recommend that you go back and listen, because he talked about recycle cost, he talked about selling cost, he talked about acquisition cost, he talked about opportunity cost, and he also talked about making a prediction about the future. So he just delivered on a plate some really, really super intel there, folks. So have another listen to that. I don't have anything further to add, Ben. Well done.
All good. Fantastic.
All right, so there you go, folks. If you have a question, and you want to come onto our podcast, go to thepropertycouch.com.au. There's a little widget on the side. Ben, leave your message. And all those frustrated Collingwood hecklers, you've just had the perfect template of what you do. You butter us up with a beautiful question at the beginning, and then you go to town on Collingwood.
You go hard on the pies. Yeah. Or if you're a Collingwood supporter, get behind us.
No, there is
side by side.
There is a filter, Ben, on the widget that won't allow Collingwood supporters.
You're going to edit that out and not even allow that to sort of come to me.
No, if a Collingwood supporter puts that in, I'll absolutely keep it in.
Good. Come on, pie supporters.
Do they have a computer? Do they know how to use a computer?
Oh, gee.
Obviously, they've got to use a computer.
About ugly property in Canberra, and here you are going it.
All right. My life hack today, Ben, is I've set myself a goal to learn how to touch type.
Oh, rightio.
And here's the thing: I can type pretty quick, but I have to look at the keyboard, and I'm like I've got no rhythm, right? I'm just, I smash it out, but and I figure I write so much, there's so much things that I've got to do on a keyboard, I've got to sort it out. I'm not like Ivis, who learned it nice and young, and now she's just bangs it out, right? So, but as you know, you got to go 3 steps back to go 4 steps forward, right? So, I've been trying to break this down. Now, so Ivis, I found out a little hack. So when I've got a spare 5 minutes, I'm trying to find out what's the hack here.
Yep.
And I found this this method, Ben, of learning, right? And so, do you know how the keys are Q, A, Z?
Yes.
And then it goes W, S,
Quartz,
X.
isn't it? QWERTY.
Yeah, but just use your finger, your little left pinky.
Yeah.
Q, A, Z.
Yeah.
Then the next one is W, S, X, and then it's E, D, C.
Yeah.
So, but that's a lot to remember, right? So I've found this little thing on the internet.
Rightio.
So the little pinky is Quiet Auntie Zelda. The next one is Want Something Extra. Next one is Every Dollar Counts.
Oh.
Run from Vicky to Get Betty. Then it's You Have Nothing. Uncle Joe's Mad. I'm King, over long periods, and then Pretty, right? So you think, what is that? I can actually remember those things. Now, granted, I had a look because I'm under pressure to make sure I got it right for the podcast. So I'm sitting there practicing, and so I'm actually starting to get some momentum with knowing which finger needs to go on which keyboard, because here's the deal, I can't sit there during the day and go down to a snail's pace to get something done just so I get it technically right. So I've had to find a hack.
Yep.
And so at the moment I'm muscle memorying every one of which finger does which letter. So I am sending a message out to my fellow
community.
I get in trouble for generalising here, Ben, but for all the people like me who just did it the old school, went from 2-finger typer to 3.5-finger typer to I'm now probably a 7-finger unorthodox typer. If you want to go textbook, there you go. Quiet Auntie Zelda, Want Something Extra, Every Dollar Counts, Run from Vicky to Get Betty. That's the left hand.
Yep.
Then the right hand is You Have Nothing. Isaac, look on your face. You Have Nothing. Uncle Joe's Mad. Uncle Joe's Mad. I'm King, over long periods. Pretty as I look at you, Ivis. So there we go.
Can I just have a shout out for the rest of us?
Yes.
Hurry up, Microsoft, and just make it voice.
Oh, yeah. But what about the challenge of being able to do it? You actually did that to me because I was like,
I'm going to push-ups going.
That hasn't been going as well as I thought it would at this time of the year. But Ivis is now kicking the boot. How's the guitar? I'm catching up with a mate on the weekend who's helping with the guitar. Just thank you for asking before you two go into a heckle. So you said to me, because I said I'm going to get the kids to learn Mandarin. You go, mate, don't worry about it. Google Translate will solve that later. So now you think that voice to text?
Voice will take over. Voice and
what's your prediction? Let's timestamp it. When will voice take over?
Look, I think we're talking about the next amount of innovation in the next 10 years will be the equivalent of the last 3 decades. That's how quick innovation's happening at the moment. So if I was to put a number on it, within 5 years.
5 years. Yeah. For the rest, whilst you're waiting, Quiet Auntie Zelda.
Just because, voice takes a little bit more bandwidth in terms of, and that's the big challenge. I mean, you remember when you used to have to, you couldn't send a file over 2 meg because it was just too big and the server wouldn't do. That's all changing, right? So voice is a little bit more, but what you'll do is you'll just send a voice message, right? So the voice message will go and you can listen to it anywhere then. You're not stuck to a machine, you're not stuck to a device. So wearables, i.e. these headphones and the glasses are really where it's going to go. So I'll just wait for that.
What about when I
like the guitar.
What about in the message somewhere around 1 minute 45, which I wanted to get to that bit, but I have to listen to the whole sort of first minute 43
to scan times 2.
Podcast advice. Did you know? Did you know? Do not encourage him, Iris.
I like to do things that are practical.
Did you know? Ivis,
this one's coming from Ivis, and I haven't seen this.
Yeah.
This is obviously, here we go.
Well, it does beg the question, why doesn't she help me?
No, I don't. All right, now what are we doing here?
What did you hear?
Oh, yes, that.
What did you hear, Yanni or Laurel?
Or something like that. It's a pain.
Come on, fun police, enjoy it.
Laurel.
Yanni.
Laurel.
Well, obviously that was Laurel. Did you hear Yanni? Or did you hear Laurel?
I heard Yanni.
Yeah, Laurel. So it's an interesting one.
So I'm missing the point here, so you're going to have to fill in the gaps for me.
This thing's gone viral, right?
Right.
Where people are saying, is it Laurel or is it Yanni?
Right.
It's a bit like, I don't know whether you've seen the ape that goes through when they're catching the balls.
Yeah.
If you
yes.
You know where the
bear. Did you see the bear?
Yeah. Did you see the bear or the ape that came across the screen when people are watching how many counts are happening?
Yeah.
And people don't see the ape, right? And he comes out and he's like, woo! And then he walks off the screen and people are like, oh, 22 catches. And they're like, well, did you see the ape? And they go, what ape? And then you replay it to them and this ape comes into shot, stands there right in the middle and walks off. Right? So it's about what you hear. But Yanni, Laurel is a big, interesting part about that story. So
Ivis, can we just break with, can you just talk? Because we'd like to know what it means.
Not sure if the word was Yanni or Laurel, but what happens is, I heard Laurel, you heard Laurel, and you hear Yanni. It's the same audio, but what causes it? Because certain people like you
are highly intelligent, and you two need to keep up.
No, certain people like you hear the lower wave of it, and then certain people like, but I get a higher wave.
I cannot hear
and
Laurel.
You're hearing Yanni.
All I'm hearing is Yanni.
No, I can't hear Yanni at all.
Wow. Okay, Ivis, that was a good did you know. So what does that mean about me, that I can hear Yanni and you two can hear Laurel? Right. Okay, Ben, what do you think it means to Ivis?
Well, it's audio pitch and how we receive audio pitch. So it's fascinating.
Right.
And I'm glad you gave me some heads up on this, Ivis, because it's not going well. As a segment, it's like it's the blind leading the blind here, and we've got a hearing impairment.
Yeah, because the thing is, right, I haven't had a touch on this, so it's going to Custard. I see where she's going with that. Now, the listeners wouldn't have heard that because she would have cut that bit out, right?
Correct.
So, but she goes, because you're saying voice to text, what if I hear one thing and someone hears another?
Yes.
Does that put you back 5 years?
Well, it might put you back a little bit if you wanted to talk to Yanni and their name's Laurel. But that's about all.
Very good, folks. So for those of you on the train, at the gym, having a run right now, digest that one.
Yeah, good luck with editing all of that, Ivis. Anyway.
Yeah. So,
knowledge is empowering, Bryce, but only if you act on it.
See you next week,
later.